shares of Johnson Controls underperformed the S&P in 2012. However, you are forecasting earnings guidance that beats Wall Street estimates for the coming year. Why the optimism?
Well, we gave earnings guidance back in October for 2013. The Street chose to sort of focus around the lower end of our guidance, which was no earnings growth next year. And we're two and a half months into our fiscal year here, and we feel pretty good in terms of the trends that are developing, that we're going to be able to deliver about a 4 or 5% type EPS growth for next year.
Your U.S. auto business rolled to a third straight year of gains in 2012. Do you expect the same in 2013?
Yeah, well, I think we feel in automotive we tend to get some visibility in terms of the growth based on customer schedules. And if you just look at sort of how we've done through the first quarter here and what we see as we go into the second quarter, we see strong growth. The consumer seems to be relatively unaffected by some of the political issues that are going around with regards to the economy. And we're pretty confident that the guidance that we gave, which is 15.5 million units of production, is on the lower end of analyst consensus estimates. And I think if anything, we probably got some upside there.
Europe has been far more problematic. What are your expectations for the European consumer next year?
Well, I don't think so. I think, again, our guidance for Europe next year is down 7%. I think, if anything, that may be on the optimistic end. I think if you look at Johnson Controls specifically, we're fortunate in that we have a lot of our exposure to the German manufacturers and at the higher end, because generally speaking, more expensive vehicles have more interior content. And those vehicles, like the high-end BMW, Mercedes, Audi, those tend to be manufactured in Europe and exported to higher growth markets like North America and China. And we've benefited from that. So I think the market's going to be tough. I don't think the consumer is going to see a bounce back in Europe next year. And but for our company, I think we feel good about doing a little bit better than the down 7%.
Will Chinese car buying offset some of that European weakness?
Yeah, most definitely. I mean, China is very quickly become the biggest automotive market in terms of unit sales. If you look at the demand that we anticipate for next year, we're sort of looking at passenger car production being up around 7 or 8%. If you look at our sales in China, we're looking for about a 15 to 20% increase in our revenues as a result of share gains in that market.
Finally, you're lowering your CapEx spending to $1.4 billion, so it's $400 million lower from last year. Why the reduction, and where's the bulk of that spending going?
It's a good question. I mean, first of all, I think I'd put the fact that 2012, you got to put that into context. That $1.8 billion was a record amount of capital for us, so even the reduced amount of $1.4 billion next year is still the second highest in our company's history. If you look at where we've kind of made those reductions, it's clearly been around our investments in Europe, where we see a significantly weaker economy impacting demand, and as a result of that, we just don't have to put as much production capacity in place.